Interesting. I had worked at two generalist firms before joining Greenbriar. I was not a transportation expert, although I had done some investing across some of our sectors. And having worked at two generalist firms, even 15 years ago, things were very competitive, and I found myself asking, how do you develop a competitive advantage, particularly as a middle market generalist fund? How do you pick your spots? And doing due diligence on many different sectors is hard. So I was drawn to the idea of a specialist fund, and I liked the fact that transportation was broad enough that I didn't feel pigeonholed. I thought it was intellectually stimulating enough because there's service, manufacturing, technology, so there's a lot going on in this space, but yet it's specialized enough to have a competitive advantage in private equity. There's sort of two aspects to our industry specialization. One is transportation is a very large area. We guesstimated at 10% of GDP. If you think about transportation, it's really the underpinnings of the economy, from aerospace, rail, trucking, logistics, distribution, and we invest across carriers, manufacturers, and service businesses. So it's a large, interesting area, very fragmented. It's changing. There's regulatory trends. There's technology influencing it. So we see it as a big area that we understand well and where we can find opportunity. And then the second piece of it is we're not suggesting that anyone invest in an index of transportation, because that would not be a good idea. We're saying that by specializing in our area, we can find the one or two or three investments each year that are truly money makers, that have a sustainable business model, that are taking advantage of secular trends across transportation. So in a sense, we're micro investors in a specialized area. Our strategy is we want every investment to do well, and because drones, it's in the nascent stage of the industry, we don't know which are going to be the winners. If we could invest in a component that goes into every drone manufacturer's product, that's where we want to be. But we don't want to be in a position where we're picking which one is going to succeed at this early stage. Yeah, when we're looking for new investments, we are looking for a couple of things. And it sounds a little bit like motherhood and apple pie, but we're looking for great management teams. We're looking for businesses that have differentiation that's sustainable. So something sticky, barriers to entry, something that gives that business a reason to exist. We are also looking for a business with lots of levers, as we call it. We don't want to bet on one narrow play, and if we made a wrong judgment, we're going to get it wrong. We're looking for businesses with a lot of ways to grow, but both top line and cost. And lastly, we're looking for businesses that we can understand and we can help. We have the luxury of being able to choose what we invest in, so we're looking for businesses and sectors that we know well and where our relationships will help the management team and the business grow. There's about a quarter of our investing has been in logistics, about a quarter in distribution, and about half in manufacturing businesses around transportation. The logistics is a very key area, and within the firm, I'm the person that leads our efforts and focuses on that area. The reason we like logistics is a couple-fold. One, it's very large. Just in the U.S. alone, folks size it at $150 billion space. There are many players. There's thousands and thousands of companies offering logistics services, so it's fragmented. The companies tend to have good financial characteristics. They're non-asset based, so from a financial investor standpoint, they are attractive. And most importantly, logistics is benefiting from outsourcing. So logistics are providing shippers, big companies, Campbell's, Kellogg's, Nike, Microsoft, with a better way to move their goods that they, as a company specializing in consumer goods or technology, are not expert at. 3PLs are using economies of scale, technology, expertise to provide transportation management or other forms of transportation movement for these shippers, to do it for them cheaper and with better service levels. So, and in the U.S., that penetration curve of outsourcing is still underway. So many big, large companies still have transportation departments and do it themselves, but increasingly they are realizing that they can actually save more money and focus on core competencies by outsourcing, and that shift of outsourcing provides a above average growth, mid to high single digit growth to the 3PL industry overall, which is one of the reasons that we find it very attractive. Generally speaking, we are looking for businesses that are not going to make or break it based on one driver that's out of our control. So we don't have any investments where if the price of fuel goes up or down, that's going to be a big deal. We're very focused on businesses where we can help make an impact. Something we do will lead to the success of the result. The market is tough, and there's a lot of deals that we've passed on because the valuation has been beyond what we could justify. But fortunately, we've been able to, still find a couple deals that we're excited about, and keep an appropriate pace. We've liked the rail space from the foundation of the firm. So for 15 years, we've thought getting in the rail space is a very attractive place to be. The cost of rail, the utilization of the railroads has improved dramatically from where it was 20, 30 years ago. So it's become competitive with ground transportation, trucking, and the service levels have become better. That's been the key. It used to be that if you ship something on a railroad, you didn't know if it was getting there in 2 weeks or 3 days, which is why trucking had such a large market share. But the freight railroads have done a great job of improving their service levels and investing in their infrastructure to make it really a competitive product with trucking, not for all movements, but for a good chunk. So certainly as we're buying businesses today, we are thinking if we're going to own this for 5 years, that we're going to own it through some kind of cycle down and being conscious of that. So as we go into 16, it just feels like we're getting closer to that. On the flip side, I suppose that at some point valuations have got to come into line. I don't know if that will be when interest rates grow up or if the economy does soften, if valuations will adjust a little bit. So that would be a positive.